What is a reverse mortgage? A reverse mortgage is a financial product that allows homeowners, typically aged 62 and older, to convert part of the equity in their home into cash. Unlike a regular mortgage where the homeowner makes monthly payments to the lender, in a reverse mortgage, the lender pays the homeowner. The homeowner still owns the home, but the loan is repaid when the homeowner moves out, sells the house, or passes away. The basics of mortgages. To understand a reverse mortgage, it helps to first know what a regular mortgage is. A mortgage is a type of loan used to buy a home. When someone wants to buy a house but doesn't have enough money to pay for it all at once, they borrow money from a bank or a mortgage lender. The bank gives them the money they need to buy the house, and in return, the buyer agrees to pay back the loan over time, usually in monthly payments. These payments include the amount borrowed, called the principal, and interest, which is a fee the bank charges for lending the money. As the homeowner makes payments, they build equity in the house. Equity is the difference between the value of the home and what is still owed on the mortgage. For example, if a house is worth $200,000 and the homeowner has paid off $100,000 of the mortgage, they have $100,000 in equity. How a reverse mortgage works. Now, let's flip things around with a reverse mortgage. Instead of the homeowner making payments to the bank makes payments to the homeowner. The homeowner can receive this money in several ways: as a lump sum, as regular monthly payments, as a line of credit, where they can borrow money as needed, or a combination of these. The money that the homeowner receives is not free. It's essentially a loan, and it's secured by the home, just like a regular mortgage. But the homeowner doesn't have to make monthly payments on this loan. Instead, the loan is repaid when the homeowner no longer lives in the house. This could happen if they sell the house, move into a care facility, or pass away. At that point, the house is typically sold, and the proceeds are used to repay the loan. If there's any money left after paying off the loan, it goes to the homeowner or their heirs, the people who inherit the home. Why would someone get a reverse mortgage? You might wonder why someone would choose a reverse mortgage. There are several reasons. 1. Supplementing retirement income. Many older people live on a fixed income, such as Social Security or a pension, and sometimes this income isn't enough to cover all their expenses. A reverse mortgage can provide extra money to help pay for living expenses, medical bills, or home repairs. 2. No monthly payments. With a reverse mortgage, the homeowner doesn't have to worry about making monthly loan payments, which can be a big relief for people on a tight budget. 3. Staying in the home. A reverse mortgage allows the homeowner to stay in their home, which can be important if they want to remain in a familiar place or near family and friends. 4. Tax-free money. The money received from a reverse mortgage is usually tax-free, unlike income from a job or retirement account, which can be taxed. The downsides of a reverse mortgage. While a reverse mortgage can be a helpful financial tool, it's not right for everyone. Here are some of the potential downsides. 1. Reducing home equity. Since a reverse mortgage is a loan, it reduces the amount of equity the homeowner has in their home. This means that when the homeowner sells the house or passes away, there will be less money left over for them or their heirs. 2. Interest and fees. Reverse mortgages come with interest and fees, just like any other loan. Over time, these costs can add up, reducing the amount of money the homeowner or their heirs will receive when the loan is repaid. 3. Loan repayment. The loan must be repaid when the homeowner no longer lives in the house. If the homeowner or their heirs can't repay the loan, the house may have to be sold to pay off the debt. 4. Impact on benefits. While reverse mortgage money is generally tax-free, it could affect eligibility for certain need-based government benefits, like Medicaid. Types of reverse mortgages. There are different types of reverse mortgages, but the most common one is the Home Equity Conversion Mortgage, HECM. The HECM is insured by the Federal Housing Administration, FHA, a government agency. Because it's a government-backed loan, there are some rules and protections in place for homeowners. For example, with a HECM, the homeowner is required to meet with a counselor before getting the loan. The counselor helps the homeowner understand the costs and benefits of a reverse mortgage and considers other options that might be available. There are also proprietary reverse mortgages, which are private loans that are not insured by the government. These loans might be available for homeowners with higher value homes or those who need a larger loan than what's offered by a HEC. How to qualify for a reverse mortgage. To qualify for a reverse mortgage, the homeowner must meet certain requirements. 1. Age: the homeowner must be at least 62 years old. If the home is owned by a married couple, both spouses must meet the age requirement. 2. Home ownership: the homeowner must own the home outright or have a low mortgage balance that can be paid off with the proceeds from the reverse mortgage. 3. Primary residence: the home must be the homeowner's primary residence, meaning they live in it for most of the year. 4. Financial assessment: the lender will do a financial assessment to make sure the homeowner can afford to pay for property taxes, homeowner's insurance, and home maintenance. 5. Counseling: for a HECM, the homeowner must meet with a government-approved counselor to discuss the reverse mortgage and other options. Repaying a reverse mortgage: repaying a reverse mortgage works differently from a regular mortgage. There are several ways the loan might be repaid. 1. Selling the home: when the homeowner moves out of the house or passes away, the home is usually sold, and the proceeds are used to repay the loan. If the house sells for more than the amount owed, the extra money goes to the homeowner or their heirs. 2. Refinancing: if the homeowner or their heirs want to keep the home, they can refinance the reverse mortgage into a regular mortgage or pay off the loan with other funds. 3. Heirs repay the loan: the homeowner's heirs can repay the loan from their own money if they want to keep the house. It's important to note that the homeowner or their heirs will never owe more than the home is worth when the loan is repaid. This is because of a feature called non-recourse, which means the lender can't go after the homeowner or their heirs for more money if the loan balance is greater than the home's value. If the home sells for less than the amount owed, the FHA insurance covers the difference in the case of a HEC. Alternatives to a reverse mortgage. While a reverse mortgage can be a good option for some people, it's not the only way to get money from a home. Here are some alternatives. 1. Home equity loan or line of credit: these are other ways to borrow money against the value of the home. With a home equity loan, the homeowner gets a lump sum of money and makes regular payments to pay it back. With a home equity line of credit, HELOC, the homeowner can borrow money as needed, up to a certain limit, and make payments on the amount borrowed. 2. Refinancing: the homeowner can refinance their existing mortgage to lower their monthly payments or get a cash-out refinance, where they take out a new mortgage for more than what they owe and receive the difference in cash. 3. Selling the home: if the homeowner no longer needs to live in the house, they can sell it and use the money to buy a smaller home, move in with family, or pay for other living expenses. 4. Downsizing: moving to a smaller, less expensive home can free up equity and reduce living expenses. 5. Renting out part of the home: if the homeowner has extra space, they can rent out a room or part of the house to generate income. Is a reverse mortgage right for you? Deciding whether a reverse mortgage is a good idea depends on many factors, including your financial situation, your health, and your long-term plans. Here are some things to consider. 1. How long you plan to stay in the home: a reverse mortgage makes more sense if you plan to stay in your home for a long time. If you think you might move in a few years, the costs and fees of a reverse mortgage might outweigh the benefits. 2. Your financial needs: if you need extra money to cover living expenses, medical bills, or home repairs, a reverse mortgage could help. But if you have other sources of income or savings, you might not need a reverse mortgage. 3. Impact on your heirs: if you want to leave your home to your children or other heirs, a reverse mortgage will reduce the amount of equity they will inherit. If this is important to you, you'll need to weigh the benefits of a reverse mortgage against the impact on your heirs. 4. Alternatives: consider other options for accessing the equity in your home, such as a home equity loan, refinancing, or selling the home. 5. Cost: reverse mortgages come with fees, interest, and other costs that can add up. Thanks for watching. Please subscribe.